The reaction in markets, a pretty even keel here, not much of a pop in equities. We actually saw a little bit of a flight to haven assets and somewhat of a sell-off in the agriculture sector. What do you make of this deal with regards to the potential tailwind that this could give markets?
Sure. So we think that a lot of the trade deal has been priced into markets already. If you go back 3 months and you look at what the market's done over the 3 months since the trade deal was announced, it's up about 12%. So a lot of that is already priced in. Buy the rumor, maybe today it's a bit of sell the news. But going forward, we do think that this does help to clarify some things for businesses, which is certainly a positive. And also, it represents that the U.S. and China can come to an agreement. And that is no small feat and a very important first step.
It certainly is, although when you look ahead to what's to follow, we don't really have any clarity on that at all. In fact, the deal simply states that the parties will agree upon the timing of further negotiations, and it's unlikely we're going to get anything before the 2020 election. That being the case, and the Fed making clear that it is on hold and not going to do anything in 2020, what's the next event risk for markets, or maybe the event that markets can anticipate? Is it too early to look ahead to, say, the 2020 election?
No, I don't think it's too early to look ahead and say that the 2020 election is a potential event risk for markets. We've gone back and we've looked at election years over history, and typically election years are positive for the markets. There have only been 4 in history. And 3 were either during the Depression or during a recession when markets were negative in an election year. So they're typically positive, but we've also seen a pattern where they can be flat to a bit volatile in the first 6 months as candidates become established and people start to assess how that election will be determined. And after the first 6 months of an election year, we do tend to see markets move higher.
So with regards to the potential for the markets to continue to move higher, we started the earnings season here. The expectations, at least in aggregate, are that we're going to see either flat to down for the S&P 500 as a whole. When you consider the expectations for earnings growth or lack thereof, and you look at some of the gains that we've made in the market over the past few weeks, do you think those two things are in sync with each other?
So our expectation is that earnings could come in a little bit higher than the market's currently expecting. So we are not in the camp where we think that there's going to be an earnings recession. Third quarter came in slightly negative. If fourth quarter came in negative, we could be in an earnings recession. We think instead that earnings are probably going to be about 2 to 3% higher than expectations. And so, that could continue to support markets here. It's probably more of that geopolitical risk that we're not anticipating right now that could cause additional volatility in the markets in, say, the next few months.